Welcome to the Accumulating Wealth Podcast. I'm Hunter Satterfield.
And I'm Judson Crawford. We're CPAs, wealth advisors, and partners at Kane Waters & Associates, a financial services firm here to help business owners navigate the decisions they face every day.
Today, we are back diving into the world of FinTalk, short-form social media videos that promise quick financial wins, bold strategies, and sometimes questionable advice.
We're pulling real videos, real claims, and real trends, and breaking them down to see what's actually true, what's misleading, and what could be downright dangerous if you don't know the full story.
Think of this as a financial myth-busting session, CPA edition.
So if you've ever watched a finance video and thought, this can't be right, or should I actually be doing this? This episode is for you. Let's go.
All right, Judson, we are back with one of our most popular episodes ever. After we did FinTalk last time, man.
It was.
Yeah, we had
Lots of good feedback.
A lot of good feedback.
Yeah, and we enjoyed it as well.
It was a blast. Although none of the feedback, Judson, said, you know what? You guys are finfluencers. I was offended by that.
I got feedback that was the case for me, from myself, but nobody else, which is weird.
That is unfortunate. For Valentine's Day, I did get a candy heart that said, you're my finfluencer.
Really?
Yeah, it wasn't from you.
Huh. Weird.
Yes.
Who is it from?
Carrie
Sanders
listens.
Graff.
Carrie listens all the time.
Yeah. Oh, big listener.
Yeah.
Carrie, if you're listening right now, it's great that you're listening.
Judson's going to give you $20 if you're listening. Just email him at Judson@KaneWaters.
Yeah, exactly.
All right. We're going to roll the first video, yeah? Game time?
Yeah. Okay. So our amazing producer, Aaron, has procured these videos from the Finfluencing stratosphere.
That's right. And we have not heard these, listeners.
No.
This is just, you're getting
First
real-time
time with
thoughts.
you.
That's right. All right, let's go.
Some investors are getting absolutely crushed by the IRS because they don't understand the taxes of investing. You do, though, because you follow me, Vivian, your rich BFF, and your favorite Wall Street girlie who's going to let you in on the secret. Okay, Mr. Day Trader, you made $30,000 this year trading stocks. Time to pay up. Ugh, fine. Here. Mrs. Investor, you made $40,000 this year investing in the market. Pay up. Not so fast. Do you see how long I'd been holding those investments? 370 days. Rats, you won't owe me anything. If you hold your investments for longer than 1 year, you'll get to pay less in taxes. I always remind the BFFs that day traders never prosper and investing is a long game, and the IRS agrees. When you hold an investment for less than 1 year, it gets taxed like ordinary income, aka like your day job, aka a lot. But if you hold your investment for more than a year, you'll only be taxed 0%, 15%, or 20% depending on how much you made. And that, my friend, is why we buy and hold.
All right, Judson, I got to start and just say that you are my rich BFF.
Yeah, I mean, I'm sad that nickname's already taken.
Yeah.
Because that would have worked really well.
I'm maybe most offended that she said Mr. Day Trader and Miss Investor.
Well,
like, why the hate?
Yeah, and
Why is the day trader got to be?
It was
a man?
the longest explanation of short versus long term capital gains that I've ever wanted to go through.
Yeah, but at the beginning she was pounding her fist, and then she said AKA like 6 times.
And then the pile of fake money that she was holding up was helpful.
That's right.
Especially when it was like, no, I don't owe you anything because I held it for 370 days.
Did she say 370 or
370?
I thought she said 377. I was like,
No.
what? What's through 370?
No, just anything over 365.
370.5, only in leap years.
Well, it's kind of like what was kind of misleading to me is like, oh, day trader, Mr. Day Trader. Well, if you're a day trader, you're not holding it. It's the complete opposite of what she's talking about, essentially. But okay, whatever.
As you said, it's the longest explanation ever of long-term, short-term.
I just want to sigh.
Yeah, I mean, the reality is that there have been times in the past where myself or a client might own something for 180 days, and we're not day trading. But you might sell it, and that's okay. It's short term. So, all right, let's run through the actual, sort of
rules
here on this. Yeah. Long story short, she is correct that if you own something less than 1 year, it does get short-term treatment, which is ordinary rates, and it is taxed just like your regular income. That is correct. But what she fails to mention is that there are still progressive tax rates in that environment. So it's not just immediately taxed at the top rate unless your other income pushes you through, because she seemed to indicate there are progressive rates over on long term, but not short term. So it is still progressive on the short term. But Judson, if you hold it longer than 365, or in her case, 370, what are the rules there?
Well, if you hold it longer, then you get long-term capital gains rates. And, she is right that there could be a chance that you pay 0% on that because, as Hunter said, there is a progressive table for that. So for a married filing jointly, we'll just take married filing jointly. If your total AGI, if your total income is at or below $98,900, your capital gains are at 0%. If it's from $98,900 up to $613,000, it's at 15%. Anything over $613,000, though, you're at the top 20% tax bracket. And also remember that these qualify for the 3.8% Medicare reinvestment tax. So you're going to have to add that on top, whether it's 0, 15, or 20%.
That's right. And if you're in those progressive rates, like, yes, if you're qualifying at 15% because your income's below that, that means your actual progressive rate on ordinary is lower as well. So, I mean, the spread is roughly about 10 to 17%, depending upon where you are. But Judson, I think it still goes back to, we have said this time and again on this episode. We tell clients this all the time. You don't ever make investment decisions because of taxes. You should be informed when you make investment decisions on what the tax implications are, tax consequences, tax implications, but you don't make a decision because of the taxes. If you're going to hold a bad investment just to get over the 365 so that you can pay some lower rate, well, guess what? If it goes down on 360, you've just lost all of that tax benefits you were waiting for. So my point in saying that is that we need to make investment decisions in a vacuum as an investment decision, but be informed by taxes, but not let this lady and her rich BFFs drive decision-making with taxes.
Yeah, and my ultimate takeaway is, I think when we're talking about this, that she, while being slightly misleading, there were some facts in there, but I wouldn't recommend follow because annoying.
Very. All right, let's go to the next video, AKA the next video, AKA the next video.
Don't ever let your parents give you their house. Instead, do what the rich do. Son, I'm retiring and giving you the house. Thanks, Dad, but can you keep it under your name for now? Do you not want our $500,000 house? Of course I do, but you've owned this house for 20 years and it's appreciated a ton in value, which means if you transfer it over to me, I'm gonna be responsible for paying all the capital gains tax when I sell it. Okay, so what should I do? Let's put it in a living trust and add me as a beneficiary. So when you pass away in 30 years, I'll inherit the property with a stepped up cost basis. Okay, so don't transfer the assets to your kid's name. Instead, put it in a trust with you as the beneficiary. Exactly. That way we don't pay taxes legally and create generational wealth. Wow, where'd you learn this? I just follow Casper for all the best money hacks.
Okay, Casper?
Casper, like the mattress company?
No, like the ghost.
Oh.
The friendly ghost, though. He seems friendly.
For those that weren't watching the wonderful video here, it's obviously the same kid talking back and forth to himself, but he went red shirt and blue shirt.
Okay, so as far as applicability goes in this, how many times in your 20-year career has a client come to you and said, Hunter, my parents want to give me their $500,000 house. What do I do?
What? You don't want my $500,000 house?
You don't want my $500,000 house, Casper?
Yeah, and the reality is if you were to do this scheme, which, fine, whatever, it works. And we've had clients that have brought it to us before. But the reality is he just acts like there are no costs to this. Right? Like there are costs in setting up trusts. There are costs to these things. This is just it's a head scratcher. And I think it's particularly that case because now we're dealing with a situation where we've got an unlimited exemption, basically at $30 million. And it's very rare that we're dealing with a client that has this exact situation. That's like, oh, transferred into a living trust so that I can get it on a step up a basis, blah, 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 in 30 years from now.
Yeah. Yeah, and I mean, he's not wrong that a gift of an appreciated asset that the recipient has a carryover tax basis. But what Casper doesn't say is that if his biggest concern is getting the step up in basis, then the best thing to do is to make sure that house is left to Casper in the will, and then murder your parents, because then upon their death you get the step up in basis. Do you agree?
Couldn't agree more.
Exactly. I need to be a Finfluencer.
You are a Finfluencer, Judson.
So we are anti-credit cards, for the record, because we just believe in spending your own money. Don't use the bank's money, even for your everyday monthly purchases. Just use your money. Just use your money. So you don't have a bill because you end up spending more on a credit card. I think, too, you're just involved in this toxic game of points and all this. Yeah, and you can rent a car. You can travel. You can do all the things with a debit card. Now, sometimes there's a little hoop, right? Not all rental car companies will take your debit card. So you need to call ahead. So there's some planning, but we travel all the time.
You know what
and
the
we're
bigger
fine.
hoops are? Playing the credit card game.
I'm sort of speechless on this one for a lot of reasons. I am feeling a little bit toxic because I do love the points game.
Okay. All right, let's just get this out of the way very quickly. Maybe there's a shred of truth in one statement she made, which is you spend more with a credit card. I mean, maybe. Maybe that's the one piece that we can take from this that's of value. The rest of it is very, very much not.
Yeah.
Really? Are there rental card companies that don't take a debit card? I'm blown away by that.
I have no idea because I've never tried to rent a car with a debit card. Okay. So okay, look, first thing is I'm not anti-credit card. As long as you can be responsible with your credit card, it is using your own money. As long as you pay it, you're using your own money. And if you pay it timely, then the only fee you have to use that is your annual credit card fee. So
if you have one.
if you have one,
Yeah. And in fact, you do get the points, but that's okay.
Yeah.
It's a toxic points game.
toxic points.
Yeah. The comment of don't use the bank's money, just use your money is completely wrong.
Yeah.
Obviously, in this situation, you are using your money. You're borrowing it for a very short time from the bank, but you are using your money and therefore not paying any interest. Again, I think the biggest takeaway here is probably if you do have issues with spending or people in your life have issues with spending, well, then absolutely, yes, a credit card can increase spending because you think that you have the money when in reality you don't. But beyond that, I mean, I think that, the use of credit cards, parents for children that you might want to, have that for your college age or high school age, or even, singles that are listening to this that have their credit card. Those are good ways to train yourself on budgeting and smart financial decisions. And I think that's just a part of the financial process of learning to manage money well. So Judson and I are obviously, absolutely in favor of credit cards, assuming you can control your spending because you can get some really good benefits from it. The other thing is obviously credit cards offer, really good protection if you have fraud and things like that. So that is a thing she didn't mention because she hates them so much.
Yeah, if you have never had fraud on either a credit card or a debit card, the process to get your money back on a debit card is significantly longer and harder than on a credit card. Typically on a credit card, you're going to get that charge taken off of your account that day and get that credit back on your credit card. A debit card can literally take weeks. And we had a scenario with somebody here at work that had significant amounts of money taken from their checking account, and it was scary. I mean, honestly, it was very scary. So, I don't love that one, I'm going to say, and I think that she's going to feel real stupid when I send her a picture of me at the Courtyard Marriott Lubbock on a free night with free breakfast.
That's right. You're just anti-debit card, Judson.
I am anti-debit card. It's true.
Here's exactly how to legally withdraw 6 figures annually without giving the IRS a single penny. You heard that right. You can actually pull a total of $126,700 from your retirement accounts each year without paying a dime in taxes. And it's not some shady loophole or sketchy scheme. It's completely legal tax planning that anyone can do. The secret lies in understanding how different retirement accounts are taxed and using them strategically. In 2025, if you're married with no other income and need $100,000 per year in retirement income, to start, you can take $30,000 from your 401k or traditional IRA completely tax-free. That's because the standard deduction for married couples filing jointly wipes out that $30,000 of income entirely. Another smart move is to postpone taking Social Security to help you draw down your pre-tax retirement accounts first. This can prevent required minimum distributions from skyrocketing your marginal tax rate later on. Plus, you'll get a higher monthly Social Security benefit. Next, you can pull out $60,000 in long-term capital gains from your taxable brokerage account without paying taxes on it either. And this works because married couples with taxable income under $96,700 fall into the 0% long-term capital gains tax bracket. In reality, you could take the full $96,700 tax-free, But for this example, you only need $100,000 total. And to round out your $100,000, you can withdraw $10,000 from your Roth IRA, which is always tax-free once you meet a few basic requirements. So just think about it. 6 figures of annual income without sending a single dollar to the IRS. But it doesn't happen by accident. You need to plan for it now. And for real planning strategies to lower taxes and invest smarter, subscribe.
I hate social media.
The worst. I mean, he is in like the span of 15 seconds, he's throwing out required minimum distributions, marginal tax rate, postponed Social Security, blah, blah, blah. I mean, it's just over and over and over again. I'm like, you're trying to do complex planning in a freaking 45-second social media video.
Yeah. At first, like when he first started saying it, I was kind of like, okay, gimmicky to get out 126 tax free. But then he started talking about the standard deduction. I'm like, okay, he's just going to do some basic tax planning on here, and maybe like he's going to like actually bring it in to where we go, okay, well that actually made sense. Maybe not the way I'd package it, but okay. Then he, after talking about the standard deduction, he said that you should defer Social Security to reduce your taxable income and take money from your 401k plan basically so you can increase your Social Security, which is going to be like a 3% per year increase. And that's when I basically started crying.
That is, by the way, the part I thought you're making an investment decision. You're making a tax decision and you're letting taxes drive your investment, right? It was just crazy. Like, so, all right, let's unpack all this, folks, because you're right. It's tough to sort of, he threw so much into one little thing. First off, anytime somebody says it's legal, it's not shady, it's not sketchy, I mean, all that stuff is him trying to basically, bait you into this video. Now, everything he mentions in there is completely legal. So we'll start there. However, his comment, quote, anyone can do this. No, anyone can do this who has a 401k account, has taxable brokerage monies, has a Roth IRA, and oh, by the way, has no other income, because if you have any other income anywhere in your life, so for instance, that taxable brokerage account, if you're earning any interest and dividends, you can no longer do what he's talking about on your 401k because it wouldn't be completely tax-free because you have other income that pushes you above the standard deduction. So that right there, the whole thing falls apart. So can anyone do this with incredibly strategic planning and maybe some very poor decisions on taxes? Sure, I guess. But it wouldn't necessarily be the path I would say either. So I really liked what he said about you have to plan for it now, because we talk all the time about diversification, not just in, what investments, sector you're in, but also from a tax perspective. And a lot of what he's talking about is what we do for clients. Like, you do want pre-tax money, you do want after tax, and you want tax-free because it gives you a lot of creative opportunities in retirement to pull at lower tax rates. So unfortunately, you can't do that 5 years out from retirement. You have to be planning for it now, since there are limits for each of those buckets each year. So I thought that was again, we're trying to always try to find the silver lining here. Other than this guy shouting a bunch of, nonsense phrases at us, I thought that was the big takeaway.
Yeah. I mean,
you just didn't like him.
I didn't. I didn't really like him. Yeah, the music behind it, the screaming, the deferring Social Security so that you could take money out of your 401k. That one to me is that's asinine.
You hear that about the S-Corp, though. I want to ask you on the S-Corps for a second. Break that down. So I go to my accountant and I say, hey, give me an S-Corp. I know you can file it with the state, but...
So many accountants screw this up. And I'm sorry, for you accountants out there listening, I'll go toe-to-toe with you. And I don't say that out of meanness. I say it out of, I can help you be a better tax advisor. And we have our Main Street Tax Pro program. We'll probably talk about it for a minute. But first, if you're an LLC, everybody listening, LLCs, limited liability companies, do not save taxes. They don't. And for some reason, people think, I got to have an LLC. I'm starting a business. I need an LLC. No, you don't. No. An LLC gives you asset protection, legitimacy, an EIN, a bank account, a way to start tracking your income and collect it and pay your bills, and saves you being disorganized and give you some asset protection. But it does not save you taxes. I don't need an LLC to take a write-off. And at the end of the day, if you make 50 grand, 100 grand, whatever you make in your LLC profit is taxed at 15.3%, self-employment tax, FICA. Well, when you convert to an S corporation, you can split up that income on paper. You don't have to wait around for a paycheck. I know business owners, your income's up and down, cash flow, whatever. But you're going to take a report quarterly and at the end of the year and say, all right, I made the same 100 grand. I just converted to S Corp. I made the same 100 grand. I'm going to take 40 grand as payroll and 60 grand as distribution. You took the money out all year long. Don't care. But on paper, it's 40 payroll, 60 draw. That means I just saved 15% on $60,000. That's 9 grand. So I just saved $9,000. This is every dentist, realtor, attorney, accountant, financial advisor, entrepreneur. Anybody making 50 to 100 grand, you're a candidate for an S Corp. You can either pay 15,000 or you can pay 6. You choose. But if you don't do it before you're in, it ain't happening.
I got to say, 3 seconds in when he was like, all you accountants are doing it wrong, I'll go toe to toe. I was like, bro, let's throw down right now. All right,
and
whatever.
that music, man, that was throwdown music too. I mean, that was some heavy music for talking about.
Yeah, I don't know.
LLCs and
What
S
I wanted to
corporations.
say is like, who the hell do you think you are coming at me toe to toe? I also loved how, before we get to the actual video itself, I loved how the subtitles on our feed kept saying escort instead of escort. You converted to an escort, and I was like, oh, okay, that's pretty shady. Okay, so lots to unpack here, folks. He is completely right on an LLC. Has nothing. An LLC gives you the asset protection. It gives you all those things. And in fact, where he doesn't double click, and he should, is you don't necessarily want to be an LLC. Some states you want to be a PLLC, PA, PC, so on and so forth. So shame on him. I'll go toe to toe with him on that. So that piece, Judson, is correct on the LLC. Now let's talk about his next piece, which is sole proprietor, which he never even mentioned those words. Sole proprietor versus the S Corp.
Okay, so he's not wrong that if you are in an S corporation, that your wages that you pay yourself are subject to employment taxes, Social Security, and Medicare, and what you take as distributions are not subject to subject to self-employment tax. So you can save that 15% on a portion of that money. I think that in very simple confines, he is not inaccurate though. Now, there are some costs to this S corporation that he didn't talk about, right? Because
Excuse me, the escort.
So the escort, there are costs to escorts. From what I understand,
No
firsthand
personal
knowledge.
experience, but yes, there are costs.
But if you go from an LLC to an S corporation, there is a separate tax return that will cost more money. There are payroll service fees that will cost you money to file your employment tax and your employment taxes and file your W-2s at the end of the year, et cetera, et cetera. So from his $9,000 in savings, there's going to be some costs to that and some reporting that has to be done. The other thing that I think is important here when we talk to our clients is, what's appropriate salary? I mean, he just divided it up, 40,000, 60,000. Maybe if you're making $100,000 and you don't have wages elsewhere. I mean, there's some more complexity here. He makes it very simple. But usually we don't, really make our clients or recommend that they switch because of some retirement plan reasons. We don't really talk about switching from like an LLC to an S corporation until their income's a little bit higher than $100,000.
Yeah, I would agree. He just ignored a lot of the details. I think that's the big takeaway here. Yeah. Again, a lot of what he said is correct. As far as the difference in hey, just an LLC versus actually converting and being treated as an S corporation instead of a sole proprietor. That being said, all the details you mentioned, all the costs, of course, he ignored. And then I think, again, the biggest one there, to your point, is if you pay yourself too little in wages, you do risk an IRS audit on the S Corp. So you can't just convert to an S Corp and all of a sudden say, I'm going to pay myself 10 and take all 90 in distribution, because you will in all likelihood get an audit. And then you let the IRS dictate what the salary is, which is punitive to you. So regardless of where he's at, he needs to talk to somebody else about going toe to toe, because he missed a whole lot in that little Finfluencer video.
Yeah, I just don't understand why he was so mad at me. I'm just an accountant.
You're an idiot accountant. That's why.
Seriously.
Right now, while the U.S. is at war with Iran, I am Mrs. Dow Jones' millennial finance expert, and obviously the human cost here comes first. But also, in a crisis, information is your best defense, so I wanted to get into it. Okay, so to fill you in, over the weekend, the U.S. and Israel launched Operation Epic Fury strikes on Iran, and Iran has retaliated. Here's why it hits your wallet. Iran controls the Strait of Hormuz, and 20% of global oil supply runs through that daily. So here are the 3 things you need to do right now in response. Number 1, lock down your digital life. Not enough people are talking about this, but physical war in 2026 is always paired with cyber war too. So freeze your credit ASAP. It's free. Let me know if you want a video on exactly how to do this, and also enable 2-factor. Number 2, do not panic sell. Yes, the Dow dropped 600 points at the open on Monday, but it's already fighting back, and safe havens like gold and Bitcoin are actually sort of popping. So remember, geopolitical dips are historically sharp but temporary, so don't pull out your money. And number 3, beat the energy tax. Gas prices are projected to jump 20 to 40 cents this week. Fill your tank today before that's priced in, and also book any upcoming travel now before airlines also bake in these fuel surcharges to your ticket. And most importantly, stay informed, not overwhelmed. Here's who I'm following for updates, and remember, don't let fear be your financial advisor. Stay rich and safe.
I wasn't on the list of people to follow at the end of her video, which is probably what is most disturbing to me.
Stay rich and safe, Judson. That's what I took. By the way, she said 3, but then she said, but most importantly, she listed a 4th.
There's a 4th.
Yeah. All right. I think the best part about this video was there is a human cost here, but it's time to make some money. All right. Where do you want to start? Hey, let's start at number 2. Do not panic sell. That was a good. Yeah,
I totally agree.
Have we said that before?
Yeah,
a little bit.
100%.
Yeah, we even talked. She talked the Strait of Hormuz, which we've talked about on this podcast.
If you listen to our drop about the war that we just made, then you probably heard those words.
That's right. So that part I thought was good. Do not panic sell. We agree with that. But then she just leveled up and she's like, but you should buy gold and Bitcoin.
Yeah.
Which is interesting.
Yeah, and fill your tank of gas, because ultimately, if you want to save your retirement, go top off your gas tank while gas is still 10 cents cheaper.
Stay rich and save, Judson. Okay, so number 2, broadly good, other than maybe just directly telling people to go buy gold, Bitcoin. You mentioned number 3. Let's go there, and then we'll go back to 1. Beat the energy tax is what she said.
I didn't really get that.
Fill your tank.
Yeah, so basically she's saying buy things now before costs go up. But what does it have to do with an energy tax?
I don't know.
Okay.
Thankfully, though, on Monday, I actually went and filled up some of the giant red canisters.
Absolutely,
and they're sitting in my.
You drained your swimming pool and filled it up with gasoline.
That's right. Yeah, because I wanted to beat the energy tax.
100%.
Yeah, I don't even know what to do with that one, because here's the thing. You're going to save, if it's 20 cents a gallon on 20 gallons, it's like $4, dude.
Yeah. But you're going to stay rich by doing it. But okay.
It's $4, Judson. Could you compound that? It's a lot of money.
You're going to put that in your Roth IRA.
Yeah.
I don't hate number 1 necessarily, just in general, like not necessarily the freezing the credit thing, but I mean, I do think that being safe digitally is important in general in this world. Like 2-factor authentication is a good thing. It's annoying, but it's a good thing. If you're at a point where you don't need credit and you want to freeze it, okay. If you want to just monitor it, because most of your credit cards now have some credit card monitoring and you need to watch if things are opened up on your credit. I mean, I think that's a good thing in general. I don't know that I'm necessarily that's not what my mind jumped to when we bombed Iran, was that I need to lock down my digital life. But
yeah, and I think that's the takeaway. Since we hadn't listened to these before, listeners, I figured she was going to say don't panic sell, but the other 2 kind of came out of left field for me. Fill in your gas tank for one time ahead of gas prices going up.
And if you use like a gas-powered lawnmower, probably do that one too.
And booking travel for, way out and going and paying that cost. I mean, I wasn't even thinking those things. I think they're, we've talked on our previous episodes in Storytime with Brad too about things you can actually consider. They're probably more important and beneficial to a financial plan. I'm not sure about the 3 things she mentioned, but regardless, I agree with her number 4 that she decided to mention, which was stay informed.
Agree.
Because I think the staying informed on what's going on, can certainly help manage some of the emotion that comes with it. The other option is just don't open your account statements and it'll be fine.
So we're basically at like 2.5 of 4.
I'm going to go with 0.75 on number 2. Yes on number 1, whatever on number 3. So I'm at 1.75.
Okay. Well, I mean, It wasn't great either way,
Yeah.
percentage wise.
Well, I was, some of the other ones were maybe a little bit better, but it's all good.
Yeah.
All right. Well, as fun as always, listeners, we kind of giggle to ourselves on some of them, but we're going to continue because we enjoyed, and again, we're trying to find silver lining to the best of our ability because some of these things are actually pretty good. So
Yeah, and if you enjoy these, let us know. We'll keep doing them because, we're here to please you guys. Bottom line.
That's right. All right, get us out of here.
All right, the best way to keep up with this is subscribe to this podcast. That way you never have to miss an episode and you can go back and listen to all the others. If you're enjoying us so far, please leave us a review. If you have a question, comment, or suggestion for a future episode, drop us a line at canewaters.com/wealth. We really do answer these. And if you want to learn more about what we're doing when we're not recording these episodes, visit canewaters.com to see how we're helping our over 3,500 clients reach their long-term financial goals. Signing off from your rich BFF.
Roses are red, violets are blue. Judson, Mr. Day Trader, you're my rich BFF.
Yeah.